Profit is an elusive concept in the world of numbers and accounts, and there are many reasons why the money in your bank account doesn't match the profit you're measuring. One of the key reasons for that difference is something accountants call the matching concept, sometimes referred to as accruals accounting. And in this week's I Hate Numbers video, I'm going to explain what it is, why it's used, how it's applied, and obviously I'll give you some examples along the way. First of all, what is the matching concept? Well, the matching concept, as I said earlier, is referred to in the world of finance as accruals accounting. It's a fundamental building block, it's a fundamental principle applied in the world of accounting that ensures that items called expenses are captured and recorded in the same period that revenues are also generated. In simpler terms, it means, just like a dating exercise, costs are matched with the income that are generated and produced. And this approach provides a much clearer and a much more accurate picture of a business's financial performance over a specific period. Profit is still a concept that's more widely understood than other concepts that we might use to measure financial performance. But what do we actually mean by the matching concept? Well, with accurate financial reporting is achieved by matching those expenses with revenues that businesses can produce. Whether that business is a theatre that sells tickets, a restaurant that sells meals, whether it's a manufacturer selling product, it makes no difference. It gives us a true understanding of the true financial performance. And this is useful for owners, investors, bankers, and other stakeholders who want to understand how the business is performing, how it's doing. Also, it provides some degree of consistency. The matching concept promotes and encourages consistency in the reports that we generate as businesses. And when we apply these same rules consistently, period on period, year on year, we can actually measure and monitor that performance over different time periods much more easily. And who doesn't want that? When it comes to making decisions, that accurate financial information is critical, it's crucial for making those informed business decisions. And by ensuring that your expenses are captured and recorded in the same time period as the revenues that are generated, notice not cash in the bank, then businesses can better assess their profitability and also make much more important strategic decisions. And that's got to be a good thing. There are other good reasons as well. Accounting standards, those are the framework, the rules that we accountants operate, and it ensures that we comply with those rules. It's much more important for companies than sole traders, and we have something called GAAP, bit of a mouthful, GAAP, Generally Accounting Accepted Principles, or IFRS's, International Financial Reporting Statements. And both of these frameworks, as well as the Companies Act, require the matching concept to be applied to make sure that financial statements are prepared correctly. Another consideration is, how is it actually applied in practice? How is it applied in a real-world situation? Well, the matching concept is applied in several ways, depending on the nature of your business and the level and the type of transactions involved. Here's some common examples that I'm going to go through with you. Let's think about something called revenue recognition. Bit of a mouthful, bit of a term. Share that with your finance team. Now, revenue is recorded when you earn that right to the money, not when the cash gets paid into the bank. So let's imagine your business is a service provider and it provides a service in the month of December, but unfortunately, the money doesn't come into your bank account until the month of January. It makes no odds. The revenue is recorded in the month that you earn it. So if you do a workshop for somebody and you invoice them in December, get the money in this January, that's income in the month of December. It's the same for expenses. We record them when we have a legal responsibility to pay for that bill. So taking that same time frame, we get an electricity bill in the month of December for electricity we've consumed, but we don't have to pay the bill until January. That is still a cost in the month of December. Now, depreciation, I'm going to talk about that in more detail in a future video. In fact, next week sounds like a good idea. Now, depreciation, I'm just going to mention it in passing, is a way that you allocate what's called a capital cost over a period of time. More of that in next week's video. Other terms that you may come across, things called prepayment. That's a bit of a head scratcher. But when you pay for something like insurance, you're paying for the insurance facility not only for today, but for future. We accountants will have to dive in there and figure out how much of that bill that we've paid relates to the period of time that we are measuring profit. Now, accrued expenses, by the way, just to make you aware, these are costs that we've borne some responsibility to pay the supplier, but the money hasn't, as of yet, left our bank account. However, we record them when the responsibility occurs, and we also record them as debts or liabilities until that payment is made. Now, what I want to move on to now, folks, is examples to share of the matching concept. To make it clearer, let me give you a few examples that you might be able to relate to that might make more sense for you. Let's think about wages and salaries. Now, supposing your company, your business, has somebody that joins you at the beginning of that month, you may not pay them until the following month. It's quite usual that we expect people to work a month or a week in hand. So even though they work for you in December, but you're not paying their actual wages until January, that is still a wage cost for the month of December. That is the month in which your employees have performed the work and earned their entitlement to the money that you owe them. Even if they leave in December, you still have a contractual responsibility to pay them. Let's think about advertising costs. Now, you run an advertising campaign in the month of November, but your supplier, your marketing agency, doesn't give you the invoice until the month of December, and you get around to paying it in January following on normal business terms. Now, that expense is recorded in the month of November. That's when the liability arose. That's when the advert was aired. That's when the campaign was run. And that potentially will be the month that you could generate some form of benefits. Let's think about sales commissions. Now, you have a salesperson who goes out there to sell your products or services. They earn the commission in March, but understandably, you want to check everything is in order, and that commission isn't actually paid through your bank account until the month of April. However, it's a cost of March, and that's when it is actually recorded. Now, the next thing I want to have a look at is how the matching concept is used in the production of the financial statements. And those financial statements, by the way, folks, are income statement, balance sheet, and cash flow. Now, the matching concept affects a company's financial statements in a number of ways. Let's think income statement first of all. Now, the income statement or profit and loss or P&L shows you your business's revenues and expenses over a specific time frame. It could be over a week, over a month, or a year. And when we match or put those costs and incomes, we get an accurate representation of the company's profits that have been earned over that week, over that month, over that quarter, doesn't matter. Now, your balance sheet, that snapshot in time, has a list of items and expenses, prepayments that appear on the company balance sheet. If you want a more technical term, by the way, folks, it's called a statement of financial position. Now, this is a pure listing document that lists the assets and the liabilities and the resources at a given point in time. Now, the last document I'm going to mention is the cash flow statement. And as a heads up, folks, here, cash is something we should always be looking at. Now, accruals don't measure and impact the cash flow directly, but it's still a device that's used in statutory accounts or as a working exercise whereby if we want to try and generate a calculation to how much cash we've generated, accruals can come into that and help us accordingly. So what can we conclude? Well, we can conclude, and I'm basing this on 30 years plus experience and having taught hundreds of accounting professionals as well, the matching concept is a cornerstone, it's a fundamental bedrock of accurate and consistent financial reporting. By making sure that we record those expenses in the same time period in which benefits and revenues are generated, we as business owners, we as not-for-profit organisations can produce those statements that truly reflect the financial performance that we are generating. This in turn gives us better ways to make decisions, promotes this idea of consistency, and it makes sure also that we comply with accounting standards. Now, for non-financial people, understanding the matching concept can give powerful insights into how businesses track their performance and manage their finances effectively. Now, folks, I hope you've got some value, some benefit from this video. If you have, I'd love to hear your thoughts on this. Does that make some sense and resonate with you? Also, please do check the show notes here for a link for the imminent launch of the Numbers Know-How business community on the 24th of June. I'm really excited to tell you more about this here. Hit the show notes. There's a link in there. You can join the waitlist. And until next week, folks, happy matching.